The first hour owns your P&L. Here's something nobody tells you when you start trading. The first hour after the London Open is where almost your entire year gets decided, not the afternoon, not the overnight, that first violent hour. And most people spend it doing the one thing that guarantees they lose. They see a big candle rip out of the open, they feel that pull in their chest, and they chase it. And that candle, the one that looks like the start of a huge move, was built specifically to take their money. Today, I'm going to show you how to sit on the other side of that trade. The side the banks are on. I call this the opening trap reversal. 3 steps, a bear chart, and about 15 minutes of patience. By the end of this video, you'll be able to spot the trap, confirm it with a number, and time your entry to the exact candle the reversal begins. Stick with me. The confirmation trick in step 2 is the part almost nobody uses. What you're about to learn. Quick roadmap so you know where we're going. Step 1. We mark the opening range, the high and low of the first 15-minute candle. Step 2. We decide whether that candle is an honest move or a trap, and I'll give you a 1-number test for it. Step 3. This is where the money is. We drop to the 5-minute chart and wait for one of 2 signals before we touch the button. I'll use gold Xauusd as our main example, because if you trade the London and New York Opens, gold gives you these traps almost every single day. But this works on GBP/USD, on the indices, on anything with a real session open. Here's a promise for later. Once you see the confirmation candle, I'll show you in step 3, you'll never chase an opening candle again. Why the open is a trap by design. Let's get the why straight, because if you don't believe the why, you'll bottle the trade when it matters. When London opens, orders that have been sitting overnight all fire at once. The big players, banks, funds, need to fill huge positions, and to do that, they need liquidity. They need lots of buyers and sellers on the other side of their orders. So how do you get thousands of retail traders to all place orders at the same second? You show them a big, fast, aggressive candle. Fear of missing out does the rest. Everyone piles in the direction of the move, and that pile of stop losses and market orders is the exact fuel the big money uses to fill the opposite way. The move that pulled everyone in gets reversed. That reversal is our trade. Read that again in your head. The trap only works because everyone chased, which means our entire edge is refusing to chase. We let the crowd throw their money on the table, we let them get flushed, and then we slide in quietly on the turn. That's the whole psychology of this strategy in one sentence. Step 1. Mark the opening range. Step 1 is the easy bit, so don't overthink it. Pull up your chart, gold, cable, whatever you trade, and set it to the 15-minute time frame. When the session opens, we let the very first 15-minute candle open, run, and fully close. We do not buy. We do not sell. We just watch it print. Once that candle closes, grab a rectangle tool and box in its high and its low. That's it. In our gold example, the opening candle tops out at 4,060 and bottoms at 4,036. So we draw a clean box from 4,036 to 4,060. It doesn't need to be perfect to the cent. Get the wick high and the wick low and move on. That box is your opening range, and every decision from here references it. 2 lines to remember from that box. The high 4,060 becomes our target if the trap was to the downside, because price loves to snap back to where it opened. The low 4,036 is the level the big buyers are likely defending. Mark them and leave them alone until the trap is confirmed. Step 2. Confirm the trap with 1 number. Now the important part, and the part almost everyone skips. Not every opening candle is a trap. Sometimes the market genuinely means it and runs all day. So how do we tell the difference between a real trap we can fade and a trend we should leave alone? We measure it. A trap candle is a fast, aggressive, one-direction candle that's simply too big for a 15-minute window. Here's the 1-number test. Put the daily ATR indicator on your chart average true range on the daily time frame. That number tells you, on average, how much this market moves in a whole day. For our gold example, say the daily ATR is about $40. That's your day's budget of movement. Now the rule. If the opening 15-minute candle has already eaten more than 20% of that daily ATR, you're looking at a trap. Let's do the maths. It's easy. 20% of a $40 ATR is $8. Our opening candle ran from 4,036 to 4,060. That's $24 of range in 15 minutes. 24 is way bigger than 8. In fact, it's about 60% of the entire day's expected movement burned in one candle. That's not a trend starting, that's a flush. Trap confirmed. One nuance that took me a long time to appreciate. 20% is only the minimum. The bigger the flush, the cleaner the reversal. When I see an opening candle chew through 70 or 80% of the daily ATR, that's when I lean in hardest, because a move that violent almost has to give some of it back. 20% qualifies, 70% excites me. And for the cable traders watching, the test is identical, you just count in pips. If GBP USD has a daily ATR of about 90 pips, 20% is 18 pips. An opening 15-minute candle bigger than 18 pips is your trap. Same logic, same maths, different instrument. Write a 20% number on your chart every morning before the open, and you'll never have to guess. Now close the loop I opened earlier. Even the confirmed trap is not a trade yet. A trap tells you a reversal is likely not when plenty of these flushes overshoot and run another half hour before they turn. So we never enter just because the candle is big. We wait for the trigger, which is step 3. Step 3, the 2 entry triggers. Step 3 is where the money is actually made, so slow down here. Keep your box on the chart, but drop your time frame from 15 minutes down to 5. Now we're hunting for one of exactly 2 candles. If we don't see one of them, we do not have a trade, full stop. The market has to show us its hand first. The first trigger I call the rejection wick. You'll know it as a pin bar or hammer. It's a candle with a long tail sticking out in the direction of the trap. On a downside trap, that's a long, lower wick. Price stepped lower, got instantly rejected, and closed back up. That wick is the fingerprint of a big buyer stepping in and slamming the door. But, and this is the bit people get wrong, we do not buy the wick itself. The wick is confirmation, not entry. We wait for the very next candle to trade above the high of that wick candle, and we enter the moment it breaks that high. Then our stop goes just below the low of the wick, under the big buyer. If they're really there, that low should not get taken out. One thing on timing. This wick can show up right at the tail end of the opening 15 minutes on that third 5-minute bar. Or it might not appear until 20, 30, even 40 minutes in after a bit of consolidation. That's fine. We are not in a hurry. The signal is valid whenever the market decides to print it. Patience is literally the strategy. The second trigger I call the reversal engulf, a big engulfing candle that eats the previous one in the opposite direction. Here, the entry is slightly different and a bit more aggressive on purpose. If the price ripped down hard and then a big candle comes back and takes out 50% of that last down candle, I enter right there at the 50% mark, with my stop just beyond the low. Why not wait for the engulf to fully complete? Because on a fast market like gold, waiting for the whole thing to engulf can cost you $3 or $4 of entry. You'd be chasing the reversal the same way the crowd chased the trap. Taking the 50% point keeps your stop tight and your risk small. That's the entire reason for the aggressive fill. One caveat, so you don't force it. This 50% entry is for genuinely large, strong, engulfing candles. If you're looking at 2 tiny, indecisive little candles, they don't count. Wait for a proper one, or for a clean break of the small candle's high instead. Small blocks are noise. We only act on conviction candles. Quick one before the live example. If this is starting to click, if you're realizing why those opening candles kept stopping you out, do me a favor and hit like. It genuinely helps the channel reach more traders who keep getting trapped at the open. And keep watching, because now I want to walk you through the whole thing on one clean gold example, start to finish, so you can see how the 3 steps stack up in real time. Full worked example Xauusd, London Open. Here's the setup. It's just gone 8 in the morning UK time, London's open, and gold fires straight down out of the gate. The first 15-minute candle drops from 4,060 to 4,036, a fat red bar. Step 1, I box it. High 4,060, low 4,036. Straight away I'm interested, because that candle is huge for 15 minutes. Step 2, I confirm. Daily ATR on gold is about $40, so my trap threshold is 8. This candle is $24, 3 times the threshold, roughly 60% of the day's range gone in one bar. Trap confirmed, and a big one. And there's a bonus piece of context. 4,036 lines up with yesterday's breakout level, so there should be real buyers waiting right underneath. 2 reasons to expect a bounce, not 1. Step 3, I drop to the 5-minute and I wait. And there it is, a 5-minute candle stabs down toward 4,033, pokes right into that support, and closes back up with a long lower wick. My rejection wick. The big buyer just showed up exactly where I expected. But I don't buy yet. I mark the wick's high, and I wait for the next candle to take it out. The next candle pushes up through the wick high, and I'm in at 4,041. Stop goes just under the wick, at 4,032. That's $9 of risk. My target is the top of the opening range, 4,060. Watch what happens. Price doesn't crawl, it snaps. It runs back up through 4,046, 4,052, and taps 4,060. That's about $19 of reward against 9 of risk, better than 2 to 1, on a move that took 20 minutes. And here's the thing I need you to internalize. That rally back to 4,060 only happened because of the opening trap. No trap, no fuel, no snapback. This isn't a random line on a chart where hoping holds. There are real orders and real players behind it. When you're positioned with the big money instead of against it, these are the moves you get. Back-to-back traps and the patience rule. Let me give you a variation that will save you real money. Sometimes you don't get one trap candle, you get 2 or 3 in a row, all in the same direction. Beginners see that and assume the strategy is broken. It isn't. Back-to-back traps just mean the flush is deeper. And remember, a deeper flush means a cleaner reversal. The setup is still on. But here's the discipline that separates winners from the people who blow up. On a run like that, you still do not enter until you see a rejection wick or a reversal engulf. Look at this cable example. The market falls and falls and falls, with no signal for nearly half an hour. If you'd bought early because it's oversold, you'd have been run over 5 times. The signal is what keeps you out of the falling knife. Eventually, at the bottom, a proper engulfing candle prints and takes back a chunk of the fall. That's your green light. Price bounces hard off the low, but only for the traders who waited for the candle. The lesson in one line. The trap tells you which way. The signal tells you when. You need both, every single time. When not, to take the trade. Before we go further, let me save you from the 2 opens that will wreck this strategy. The first is a high-impact news open. If the session opens straight into something like UK inflation, US non-farm payrolls, or a rate decision, that opening candle isn't a liquidity trap. It's a genuine repricing on real information. Fading that is standing in front of a train. Check the economic calendar every morning. If red news lands in the first 15 minutes, sit this one out. The second bad open is a quiet one. If the first 15-minute candle is small, under that 20% of ATR threshold, there's no trap and no fuel. No flush means no snapback. If it's not a trap, there's no trade. Boring mornings are a filter, not a failure. So your pre-open checklist is 3 quick ticks. 1. Is the calendar clear of red news in the first 15 minutes? 2. Is the opening candle bigger than 20% of the daily ATR? 3. Is there a level nearby yesterday's high, low, or breakout for the reversal to lean on? 3 yeses, and you're hunting. A single no, and you wait for tomorrow. London or New York, which open to trade? People ask me which open is best, and for a UK audience, the honest answer is trade the one you can actually sit in front of. The London Open, around 8 in the morning UK time, is the cleanest for gold and for cable. It's your morning, you're fresh, and the liquidity is enormous. If you've got a day job, the New York Open at 1:30 in the afternoon, UK time gives you a second, equally tradable shot. There's a sweet spot most beginners miss, the overlap. From about 1:30 to 4 in the afternoon UK time, London and New York are both open at once, and that's when the biggest, most reliable traps print on gold. If you can only trade one window all week, that overlap is the one I'd pick. Volume is highest, so the flush is cleanest, and the snapback is fastest. One thing to respect about gold, it moves in dollars fast, so your stop distance can look scary. That's why we size down. A $9 stop on gold might be the same real risk as an 18 pip stop on cable once you adjust your lot size. Never judge risk by how big the number looks. Judge it by the percentage of your account. Always 1 to 2%. Second example, GBP USD New York Open. Let me show you the mirror image, an upside trap on cable, at the New York Open. So you see the strategy works both ways. It's 1:30 UK time. New York comes in, and GBP USD spikes upward. The first 15-minute candle rips from 1.37 to 1.3722, a fast 22 pip push. I box it range high 1.3722, range low 1.37. Confirm the trap. Cable's daily ATR is roughly 90 pips, so 20% is 18. This candle is 22 pips comfortably over the threshold, and it's stabbed straight into yesterday's high, a classic spot for a stop hunt above resistance. So the story writes itself. Retail buyers chasing the breakout, big money selling into them right at an obvious level. This is an upside trap, and I'm now looking to short the reversal down to the 5-minute. A candle pushes up to 1.3725, gets rejected instantly, and closes back down with a long upper wick, an inverted rejection wick, the bearish version. I don't sell the wick. I wait for the next candle to break below the wick's low. It does, and I'm short at 1.3712. Stop just above the wick high, at 1.3727, 15 pips of risk. Target, the bottom of the opening range at 1.37, managing the trade once you're in. Getting in is only half the job. How you manage the trade turns a good entry into a good month. Here's my default. The moment price moves in my favor by roughly the size of my risk, I take partial profit, usually half the position, and slide my stop to break even on the rest. From that second on, the trade cannot lose me money, and I'm holding a free runner toward the opposite side of the range. Where do I take the rest? The opening range boundary is my first, most reliable target, because that's where price naturally wants to return after a flush. If the move is strong and the wider trend agrees, I'll trail behind each new 5-minute swing and let it run past the range. But I never get greedy on the core. Bank the first target, protect the rest, and let a winner breathe. And when do I bail early? If, after my trigger, price closes back below the rejection wick's low or above it on a short, the reason for the trade is gone, and I'm out before my full stop even gets hit. A signal that fails fast is information. The big buyer I was betting on didn't hold. Cutting there keeps my losers smaller than my winners, which is the only maths that matters long term. Price rolls over and slides back through the range to 1.37, and if momentum's strong, it runs well past it, which is exactly why partials matter on trades like this. Same 3 steps, opposite direction, different pair, different session. Once you see the pattern, you see it everywhere. 3 mistakes that quietly kill this setup. Mistake 1. Entering on the wick candle itself instead of waiting for the break. The wick is a hint, not a signal. Enter early and you're just guessing the low. And on a deep flush, the market will happily print a second lower wick and take you out. Always wait for the next candle to confirm by breaking the wick's extreme. That one rule alone will cut your losers dramatically. Mistake 2. Ignoring the level. A trap that reverses off yesterday's high, low, or a round number is far stronger than one that reverses in the middle of nowhere. If your flush ends at a spot the whole market is watching, the reversal has backup. No level nearby? Cut your size or skip it. Context is what turns a coin flip into an edge. Mistake 3. Revenge trading. A missed open. You blinked, the trigger came and went, and now you're chasing 20 minutes into the move at a terrible price. Let it go. This strategy prints almost every session. The money isn't in catching every single one. It's in only taking the clean ones and passing on the rest with a straight face. How to practice this week. Before you risk a penny, do this drill for 5 sessions. Each morning, before the London Open, put the daily ATR on your chart and write the 20% number in the corner. When the first 15-minute candle closes, box it and ask one question. Is this range bigger than that number? If yes, screenshot it and label the trigger candle when it appears wick or engulf. No money, just reps. After 5 mornings, you have a folder of trap setups and you'll start to feel the rhythm which flushes snap back fast, which ones limp. Then, and only then, take it live with the smallest size your broker allows. Risk 1 to 2% per trade, no more. This edge only compounds if you're still in the game next month. The whole strategy, in 30 seconds. Let's lock it in. 1. When the session opens, let the first 15-minute candle close and box its high and low. 2. Confirm it's a trap. Its range must be 20% of the daily ATR, and the bigger, the better. 3. Drop to the 5-minute and wait for a rejection wick or reversal engulf. Enter on the trigger, stop beyond the wick or low, and target the opposite side of the opening range. And the mindset underneath all of it, your edge is patience. You are not the trader chasing the big candle. You're the one waiting for the crowd to get flushed so you can take their exit as your entry. Master that one idea, and the open stops being scary and starts being the best hour of your trading day before you go. If you got value from this, subscribe and turn on the bell. The next breakdown drops next week, and I'll show you how I manage these trades once they're running, where I take partial profit, and how I trail the rest. Drop a comment with the pair you trade the open on, and I'll take a look. Now go and mark up tomorrow's London Open. You know exactly what to watch for. Not financial advice. Trading carries risk. Manage your risk. 1 to 2% per trade. Thanks for watching. I'll see you in the next one.